now, Kenyans could be in for a tough year as the government struggles to fund the multi-billion shilling infrastructure projects it has lined up. According to analysts from global investment firm Pinebridge, increased spending could see the government turn to heavy domestic borrowing, as options to borrow overseas are proving to be rather costly, a trend that leaves income tax as a viable avenue to tap into for the state. Here's more on that.
With Kenya's economy pegged to grow above 5% in 2016, it may seem like this year has a lot to offer. But there is a caveat.
Our projections are the currency will be a bit more stable going forward, especially in the first quarter of the year.
Anecdotally, and the reports we're seeing, is that agriculture is still going to perform reasonably well over this rainy season.
Significant pressure is mounting to fund an ever-rising budget that stands at 2.2 trillion shillings this fiscal year. The country is taking up mega infrastructure projects ranging from the standard gauge railway, the 10,000 kilometers road annuity program, the last mile electricity connectivity, port modernization program, as well as the expansion of the Jomo Kenyatta International Airport. And analysts from Pinebridge say funding these projects could come with a serious downside.
The government is under a bit of pressure to undertake what we call a fiscal consolidation, less to be much more prudent in the way it spends and much more targeted in its expenditures.
The National Treasury in 2014 went to the international markets to float a $2.75 million Eurobond. At the time, the debt was weighted at an average interest rate of 6.6%, but currently this option might not be feasible.
Dependent on whether the government can be able to raise the ordinary revenue, the level of borrowing is expected to increase. We've seen that has been the trend.
Given the interest rates that we see in the international markets for Eurobonds, I suspect that the government will be unlikely to look to seek Eurobond funding in 2016, because most African countries who've raised Eurobonds now would have to borrow money at about 10% or more in that market in US dollars. So I think it's much more likely that we're going to see local government borrowing continue and to fund this expenditure.
This then leaves the Treasury and the taxman in an awkward position, as revenue targets have consistently fallen below targets. So far, the state has already reviewed the value added and the excise taxes. And now the low-hanging fruit seems to be income tax, which will hit consumers where it hurts the most.
We're also going to see, wider, more taxes.
The onus will now be for the taxman and indeed the National Treasury to actualize the ambitious programs without contradicting the presidency, which has gone on record barring any new taxes being introduced without necessary justification. Abi Agina, KTN Business.